welcome to Market Domination. I'm Julie Hyman, Josh Schaefer, a different Josh sitting next to me today, Schaefer instead of Lipton. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Well, it's critical for Nvidia to show that when AI infrastructure spending starts to slow, that they have a plan B. And the plan B is essentially putting AI on board with their project digits, more and more capability for AI away from the data center and into things like the latest laptops and smartphones. The straw that is going to stir this drink is AI GPUs in the data center.
Well, the fact that job openings are starting to climb again, reverse a trend that we have been seeing for several months, and the fact that it's going back up, I think, is an indication of the fact that the transition from, a desire to cut costs to an environment now of trying to go for top-line revenue growth is starting to unfold in the economy.
The investment will support massive new data centers across the Midwest, the Sunbelt area, and also to keep America on the cutting edge of technology and artificial intelligence. In particular, the first phase of the project will be in Texas, Arizona, Oklahoma, Louisiana, Ohio, Illinois, Michigan, and Indiana.
We got 1 hour to go until the market close, so let's take a look at the major averages here. And what we're seeing on the day is, here we go, going up to the Dow. What we're seeing on the day
red we were looking for,
is some red, exactly. We started out the day in the green, and then things sort of started to fade here. Right now, the Dow is down more than 150 points. The S&P 500 down about 1%, but it's really the Nasdaq that's leading declines again. And for that, we can perhaps look to the bond market, right? We've got the 10-year yield starting to push higher again. We did get some economic data today. We got JOLTS, we got ISM services, and both of them may be coming out a little hotter.
Yeah, so that job openings report coming in, job openings a little bit higher than expected, but I really think it might have been that ISM data, Julie. So ISM prices paid reaching its highest level in nearly 2 years. Some economists saying, well, that can be a feed forward into inflation, a concern for inflation moving forward. If that's been what part of our concerns are here, the Fed higher for longer, you're going to get this move up in yields up about 7 basis points today on the 10-year, near 4.7. We're getting close to the levels we haven't seen since November 2023. And overall, when you think about that story, yields higher recently in the stock market has not been good news for stocks, and we're seeing that play out again today.
Yeah, here we are with the 2-year chart, and indeed, going back here, that's around November 2023 when we saw this kind of similar level. We're also watching technology, and as we know, even though it doesn't necessarily make logical sense. Yes, we're going to go back. There we go. That we've got this yields higher, tech lower equation. These companies don't necessarily have a lot of debt, for example, but this has been the trend that we have seen. And in particular, Nvidia, which was getting a little bit of a bump up after Jensen Huang's keynote CES, that has now melted away.
It has, and you zoom out over the 2-day here, Julie, right? We were talking yesterday at the close. You had an Nvidia record high, right? Their first record high in a little while. So interesting to see as Jensen Huang speaks, maybe not enough for investors to some perspective, but again, also stock up about 180% over the last year, so you always got to put this one in perspective.
Definitely, and we're going to talk a little bit more about that one later on, but you see all of the Mag 7 is trading lower in today's session. It is not just Nvidia. Tesla also taking a big hit.
All right, Julie, we have the perfect guest to break down more of this market action for us. So for more on today's sell-off as investors begin pushing back on when the Fed could cut rates next, let's welcome in Michael Aroney, State Street Global Advisors Chief Investment Strategist. Michael, I want to start with that move up in the 10-year that we've been seeing. I'm curious just how you're thinking about that move higher. Is it at a level now where it's concerning for you for stocks? Is there a future level you're watching? What do you feel like is moving the 10-year higher, and how big of a concern should it be for equity investors?
So, Josh, I think there's a few things that are moving the 10-year Treasury yield. I think one of the things you highlighted is that the economic data has been a bit better than expected. So yields are priced on economic growth expectations, inflation expectations, and term premium. And all three of those things are going up, and that's pushing yields higher. But from my perspective, I think investors are wrongly obsessed with how many Fed rate cuts we're going to get this year. So, for example, in 2024, we were expecting 6 to 7. We only got 3. As long as the economy is growing, inflation's headed in the right direction, the labor market's strong, consumers strong, and businesses' earnings are good, stock markets can do well. So again, I think we're a little bit too obsessed with the 10-year Treasury yield. There is some level of real rates that becomes problematic. And I do think we are approaching that 4.75 to 5% range on 10 years that may expose someone somewhere. But overall, the economy is doing well, earnings are growing, and I think that's where the focus should be.
So it sounds like, Michael, that even if we get into maybe that danger zone of 4.75 to 5, that you think that you wouldn't even necessarily see that broad a swath of companies directly affected. Would it affect sentiment, though, in the market?
I think that is the key here, is that both an obsession around Trump administration policy, which again is fundamentally contradictory. Some of the Trump administration policies will be pro-growth and inflationary, while still others will curtail growth and be disinflationary. The timing, the size, the magnitude is uncertain, and the impacts won't be felt until 2026. Similar with the moves in interest rates, I think, again, we're obsessed with how many cuts we may or may not get, and investors are overlooking the fact that earnings are going to grow 12% for S&P 500 companies year over year this quarter. That's going to start, the earnings results are going to start coming through next week. They're going to be very good. And then ultimately, that's higher than both the 5-year and 10-year averages in terms of earnings growth. 6 or more than half of the economic sectors are going to grow their earnings by double digits. That should be the focus of this market, not Trump policy that's uncertain, not how many Fed rate cuts we're going to get. As long as the economy's growing and earnings are growing, this market can continue to move higher.
Michael, is there a concern at all, though, that if the Fed were to keep rates, we'll call it higher for longer, as we like to say, right, maybe throughout all of 2025, they don't cut rates, is there a concern coming back that would weigh on the economy in some way, and this sort of U.S. economic resilience narrative that we've been running with here could be at risk at any point in 2025, maybe later 2025?
Potentially, and I do think that ultimately what you'll need to see is some softening in the labor market. And the labor market has softened some year over year. The rate of job gains has slowed, the unemployment rate has ticked up, but jobless claims remains low and is a leading indicator of labor market strength. We also, you showed the clip as we started today's segment around kind of job openings, and that suggests that businesses are in fact going the other way. So Josh, I really think that a signal of kind of economic weakness or concern would start to show up in the labor market. There has been some softness, but just not enough to suggest that we're headed towards recession. And in fact, I think Friday's labor market data, which again will be market moving, will likely surprise us on the upside. And so that, again, the market will fret about, oh, well, that means we're going to have far less Fed rate cuts. Who cares? As long as the economy's growing and earnings are growing, I think we can continue to move higher. I wish that the market would come around to that view. We'll see if they do in the coming days and weeks.
Well, you know, the market is not exactly a heads down, serious, you know, we talk about it as though it's sort of a toddler at times. You know, Michael, I take your point as well about the market being sort of unhealthily obsessed with Trump's potential policies as well. But to play devil's advocate for a second, I got to ask you about a couple of the more out of the pale things that he talked about today. You know, taking over Greenland. Oh, Canada? Maybe Canada should become a state of the United States. You know, how do you think about whether these things sort of go to if they actually end up happening? And I don't know, how do you take all of that into account, I guess? I don't even know how to ask the question because it is so sort of wacky, some of these things that we're hearing about.
I think that Trump's kind of approach is very simple in a lot of ways. I think in order to understand what we should expect from the Trump administration and Trump policy is basically 3 things. You just get a list of the campaign promises, and I think somewhat refreshingly, and this isn't a big advocacy for Trump or anything, but you get a list of the campaign promises, and I think he's going to try to tackle and make progress on some of those, whether it's tax cuts, whether it's immigration policy, and the like. And so that's one thing. The second is you just read the art of the deal. And so he says all these kind of outlandish things, aggressive things, kind of really as a starting point, as a bargaining chip. And I think that you're seeing some of that with the hopes to negotiate something better. And then you just got to go watch reruns of The Apprentice. And that's where you'll get all the chaos. That's where you'll get all the turnover and the people coming and going. That's ultimately what I think you'll get in the Trump administration. But a lot of these outlandish comments and kind of objectives largely will go by the wayside. Look at what's already happened this week with tariffs. There's already news that the tariffs are not going to be as big and bold and as expansive as expected. Look at what's happened with the legislation bill. Oh, it's going to be one bill. It's going to include everything. Well, if it's in two bills, okay, that's okay. I could do two bills. You're seeing how this is going. We've lived this movie or seen this movie before, and I think that's more likely what you're going to get. And that's why I think investors are too obsessed with what all the outcomes on this. Some are pro-growth and inflationary, some will curtail growth and are disinflationary. The process is ugly, and the impacts are down the road. So let's focus on the earnings. Let's focus on profit margins, and those are really good.
So, Michael, do you consider any of those policies, though, when thinking about sort of what sectors you're getting into, right? Say financials, if deregulation is supposed to help financials in the next year, do you not expose yourself to that because it's an unknown of what Trump is going to do, or do you expose yourself to that for reasons outside of what Trump could do just because you feel like maybe that's a good sector?
I think the attractive opportunities are where earnings growth, the gap between earnings growth of the tech sector and the Mag 7 in particular, and the investment opportunity is narrowing. And that I also think that you want to lean into areas where they're insulated from trade protectionism. They have more of their revenue done kind of more domestically oriented that will benefit from deregulation and lower taxes. So I think that's U.S. small cap stocks. I think that's financials. You mentioned financials. Regional banks in particular will be acutely impacted in a very positive way with deregulation, M&A activity, an easier Fed posture in terms of regulation and the like. And their profit margins are high and growing already. So I think you lean into more of the domestic kind of U.S. high revenues where tax rates are going to go down and they will benefit from some of the policies, but also where the earnings growth gap is closing with the technology in the Mag 7 and that trade at better valuations. So I think that's small cap stocks. I think that's financials and regional banks in particular, for example.
Michael, good to see you. Thanks so much for joining us.
My pleasure. Thanks, Julie.
We're just getting started here on Market Domination. Coming up, Nvidia CEO Jensen Huang gave his keynote speech at CES last night, unveiling a flurry of updates on upcoming Nvidia products. Yahoo Finance's Dan Howley spoke with Jensen at the tech conference to discuss what's next for the chip giant, and you'll hear that interview next.
We're here with Jensen Huang. He is obviously the CEO and founder of NVIDIA. Jensen, thank you so much for joining us. Huge keynote last night, opening CES up, everything from robots to new gaming rigs. I guess one of the main things that you had mentioned was how we're entering the age of physical AI.
Yeah.
As far as that goes for NVIDIA on the revenue front, when do we start to see that pick up? We have, obviously the self-driving cars, the robotics. We have a robot down there that's giving Candy or Will.
Yeah.
Where does that start to feed into the revenue stream?
Well, in order to train a robot, you need a lot of data. And the first version of consumer robots that we're all going to engage is a self-driving car. And we've been working on self-driving cars now for some time, and the business is some $5 billion estimated run rate this year. And that kind of puts it in perspective. And the reason for that is because in order to build a self-driving car, you need to train a mountain of data, video data. And NVIDIA's data center business is very important to us. And so in order to build robotics, you need 3 computers. You need the training computer, that's DGX. You need the simulation computer for Omniverse, and NVIDIA is also in the simulation business. Computer graphics is not just for playing video games. You could use it for simulating virtual worlds for self-driving cars. And so the simulation computer is a very big business for us. And the third one, of course, is the robotics computer. All 3 computers are big businesses for us. And so if you just imagine, if just right now where the self-driving car business is, if it's already a $5 billion business for us, imagine how big it's going to be when we have 100 million new cars per year, 1 trillion miles driven per year. This is likely going to be one of the largest robotics industries in the world and one of the largest computing industries in the world.
And then this is the Thor chip right here that's going into cars as
This
well
is
as
the new
robots.
Thor. Yeah, this is the new Thor robotics processor. It's 20 times more powerful than the last one. It runs Transformer Engine, the Blackwell architecture, and this will go into self-driving cars. It'll go into robots. It'll go into all kinds of stuff.
Well, the other thing that you guys had announced is a new super chip, the GP10, and that's running in digits. And this is this desktop, basically AI supercomputer.
Yeah.
Right. I guess when you look at something like this, and then you look at the customers that you have, the Microsofts, the Amazons, they're running their own versions of supercomputers in the cloud. How do those two compute? How do they come together? You have someone who could buy this who may not be a customer for them. So how does that work out?
The way to think about that is we have AI supercomputers in the cloud, and but people would like to have an AI supercomputer personally. It's a little bit like personal computer complementing cloud computing. And so we have, in the case of the computer industry, we started in the PC, went into the cloud. In the case of AI, we started in the cloud, we're coming into PCs, into personal computers. And so if you were a developer and you would like to have your own personal cloud, you could get one of those digits and have it all to yourself, and all of NVIDIA software runs on it, which is really a miracle. It runs on something that small, and so everything that you want to do in AI, you could do on that, or you could do it in the cloud. It's up to you, and we want people to be able to access NVIDIA AI however you like to do it.
And all of this is based on Blackwell. And I know during the presentation last night you said Blackwell's in full production. So what kind of uptake are you seeing from customers so far with regards to Blackwell?
Demand is incredible, and we're racing to get Blackwells into every data center in the world. All the cloud service providers have now stood up Grace Blackwell systems. They're liquid cooled and NVLink 72, and we have some 45 factories around the world building the systems necessary to deliver to them, and so it's going to be pretty exciting.
So when does Blackwell eclipse Hopper for revenue share, right? Because everybody's still on, or the revenue from Hopper is still coming in, but then Blackwell, you imagine, was going to take over. So when does that switch happen?
I would suspect probably early this year. I would like it to be as soon as possible, but of course Blackwell is still in allocation, and we're trying to ramp up the production, and but it'll be soon.
I guess gaming. This is for me, by the way. Gaming is obviously was a huge part of last night. How important is gaming to NVIDIA still, with AI being the huge kind of moneymaker now?
Gaming is super important. But gaming as an industry is going to get revitalized by AI. Both the content creation part of it is the cost of creating content will go down because of AI, and the games are going to be more interesting because of AI, and the games are going to be more beautiful because of AI. You know, the technology that we announced last night, DLSS 4, is just utterly incredible, and we fused AI and computer graphics, programmable shaders, and AI into this thing called Neuro shaders, and so we've even brought AI into computer graphics, and so I think the video game industry is going to get revitalized by AI, which is really great. But computer graphics is essential to almost everything that we do as a company, and we use it for simulation, we use it for design, and it's going to be a very important part of our business for a long time.
Part of that announcement with the RTX is being able to run AI on an RTX system. Right? So I have a PC at home.
Yeah.
I have an RTX system. I can run AI models.
Yeah.
What does that look like going forward?
This is Blackwell.
I mean, yeah.
I mean, this is literally Blackwell. The Blackwell architecture that we have in the cloud that we use for supercomputing is right here. And so the thing that you'll be able to do, of course, you'll be able to create your own AIs if you like. We have a cloud called ai.nvidia.com, and we put a whole bunch of AI models up there, and these AI models are all prepackaged into what we call NIMs. They're vision models, language models, animation models, physical models, digital biology models. Whatever you would like to do as a software engineer, developer, creative artist, you could go download those models and go create your own AI, and just runs on your PC.
I guess just as a final, we're looking at these new kind of custom chips from the likes of Broadcom. How does that kind of connect with NVIDIA? Where does NVIDIA see the advantage versus something like a custom chip for Broadcom making for a Google or one of NVIDIA's other customers?
Well, the fundamental trend is very clear now. When you take a step back, what it says is that everybody now realize accelerated computing is the path forward. And general purpose computing that we have in the past, $1 trillion worth of data centers we've already built, those data centers are going to get modernized. And so the first takeaway is that accelerated computing is now clearly the path forward. The second thing is we do things that are very, very different. NVIDIA, of course, our architecture is open. It's fairly pervasive. And as a result of that, you could put NVIDIA in every cloud. You could put NVIDIA in every company. You could apply NVIDIA into self-driving cars, into robotics, because it's so versatile. And so I think the fact that our architecture is literally everywhere makes it the best architecture for developers, makes it the best architecture to innovate on, and it's the best architecture to build new industries like robotics and self-driving cars and others. And so, I'm quite excited about the future for accelerated computing and AI.
Let's check on NVIDIA shares on the back of all those announcements that Jensen Huang made at CES. Now, initially, the shares rose in advance of his comments yesterday to a record, as Josh mentioned earlier. But since then, they have come down in today's session, and now they're right around the lows of the day, Josh. And it, this isn't that unusual, I guess, for NVIDIA to sort of rally and then fall and then rally and then fall. So we're seeing a similar pattern.
Yeah, shares I think actually opened higher today too. They were at least higher in the pre-market, Julie. And then, you take a look at this drawdown, and NVIDIA, as big of a stock as it is, and we've talked a lot about it driving the market, right? And it's this massive company now. It's overpassed Apple and teeter-totter with Apple and Microsoft for the largest company in the world. It's still a pretty volatile stock to some extent. So to see it down 6% isn't, I guess, as eye-popping as it would maybe be when you see an Apple down 6% as they're making announcements. I don't know. I feel like at some point this stock has had meme-like features to it at times where it doesn't shock me as much when we see these big swings with it. But I think overall, it doesn't seem like there was much out of the actual news in the last 24 hours that I've seen any type of analyst commentary on or anything where people are actually concerned about what it means for the future for NVIDIA. It hasn't seemed like there's a lot of outspoken disappointment by what we heard from Jensen Huang at CES.
Well, and as the analysts over at Stifel pointed out, the announcements are significant but long-tailed. In other words, it's not something that is going to necessarily affect the bottom line or the top line, for that matter, at NVIDIA this year. It's more like the longer-term vision from Jensen Huang and what that's going to mean for the company. And as we know, investors are pretty short-termist when it comes to this stuff. But right now, the stock is down. I mean, even though, yes, we have seen it be volatile at times, I was looking back, it's fallen the most now since September 3rd. On that day, the company got subpoenas from the Justice Department in an antitrust probe, to just by a point of comparison.
Yeah, and one other thing I'll bring up, Julie, it reminds me a little bit of another company that talks about autonomous cars a lot and how that doesn't usually move the needle for it, right? I think for the investor story, Jensen Huang made a great pitch there, or Dan Howie there, talking about, well, if autonomous cars is a $5 billion business now, imagine when there's $100 million self-driving, or 100 million self-driving cars, how that business grows. Your head can get there. I think I'm just still sitting here wondering, when does that happen? Right. And it doesn't feel like we're in 2025 now. It doesn't feel like that's a 2026 story or a 2027 story. So when is it coming? And it's a little bit of wait and see, I think, and investors maybe get slightly impatient. I don't know.
Yeah, it seems that way.
That way. We're going to stick with Nvidia, though, Julie, and we're going to turn to Logitech. Those shares rising as the company says it's collaborating with Nvidia and In-World AI to unveil an artificial intelligence streaming assistant. So streaming assistant, pretty interesting here. So essentially, you can have an AI assistant. One of them can serve as a producer, so it can automatically adjust scenes. It can pop up things for you. It can play music for you. And then we're talking about gaming streaming here, so it can play music as moments get intense. Basically like a little chatbot at times, producer at times, that basically makes your stream better, because a lot of these people are streaming obviously by themselves, kind of in a room just playing, right? So you have a little assistant there. I don't know, it sounds kind of cool.
Sure, who doesn't like that? I mean, Logitech shares haven't done well really over the past year, so this is also a little bit of catch up for them, although like Nvidia itself, the move has faded as the day has gone on. But it feels like we've been hearing from a number of different quarters that while the AV stuff may be far in the future, that this could be the year of the sort of AI assistant, right? The AI agent, if you will. And so this seems to be sort of a version of that.
It does, and I think the question for me is this something that actually helps Logitech from a profitability standpoint eventually drive earnings in the long run, right? Or is it just a cool feature, something like we talk about with Apple's AI, right? Right now we're all looking at our iPhones and saying, oh, the new emojis are cool and the different things that can tell me what directions is cool. Is it actually making me buy the product over another product? I think that's still kind of the AI question with a lot of these announcements. Okay, I like that. That's kind of fun if I have it.
But is it
bringing me to the store?
Well, on the Apple front, Craig Moffett and Moffett-Nathanson said today it is not driving sales and downgraded the stock to a sell. But that's another story for another stock. And speaking of other stocks, let's turn now to Meta. Exactly 4 years ago, following the January 6th insurrection, Meta CEO Mark Zuckerberg announced that Facebook and Instagram would be banning then President Trump indefinitely. He wrote in part, "We believe the risks of allowing the president to continue to use our service during this period are simply too great." Today, with Trump set to retake the White House, Zuckerberg announced that Facebook would end its fact-checking system and move content moderators from California to Texas. Joining us now is Naomi Nix, Washington Post staff writer who covers Meta. Thank you so much for being here, Naomi. And so that sort of abbreviates the arc of Facebook and how it has approached content moderation. How are you thinking of today's announcement in the context of sort of what has come before it and how Facebook has approached this in the past?
It's really a 180 for the company. I mean, it was just a few years ago, right, that Mark Zuckerberg and other top executives would tout the fact-checking program as a way that the company was protecting the public from potentially harmful speech. And now we're hearing Mark Zuckerberg really align himself with Republican talking points, saying the fact-checking program, essentially increased censorship, that it was too biased, that it led to too many errors, which are long-standing criticisms of the program from conservatives and Trump world folks in particular. And so this is a significant departure.
And Naomi, it's Josh here. I'm curious, obviously Zuckerberg calling out Trump in his video there, how much of how outspoken the president-elect is, do you think plays a role in this, in the fact that he would probably continue to talk about content moderation as he gets into the Oval Office? Does that play a key role in them making this decision here?
It likely does. Not only has the president-elect been very critical of Mark Zuckerberg in the past, and critical of the company's move to, take down content, including his own accounts. When he assumed power, there would be significant regulatory pressures facing the company. They're facing an antitrust investigation and case. There are other potential regulations that the Trump administration could push through. We see Congress has been investigating tech companies like Meta for potential bias and allegations of censorship in terms of how they moderate content. We've seen the SEC chair also raise those concerns. And so there's a lot of incentives to Meta's bottom line for the company to make these kind of moves to appease Trump and Republicans at a time when they're set to take power in Washington.
Naomi, and of course, this is part of this move is not in isolation, right? Of course, we've seen Zuckerberg himself sort of attempt a rapprochement with Trump, donating to the inauguration. We also had a recent appointment of Dana White to the board of the company, which I know you wrote about as well. And Joel Kaplan is going to be the chief global affairs officer, who is a Republican. Are we hearing anything internally at Facebook? How are employees reacting to these moves seemingly going in a particular direction?
It's a good question, right? Because look, the base of Silicon Valley and a lot of these employees are, in fact, very liberal. And the moves that they're making are very much aligned with the Republicans. As you mentioned, all of those staffing moves further push the office into a conservative territory. And so I think we can expect to see some friction there as the company continues to roll out potentially new policies that further align the company with Republicans and their concerns. Whether the employees are satisfied with those changes, in the past we've seen employee uprisings about decisions the company has made. And so the real question will be, whether the company will be able to continue to make these moves while holding on to the trust and faith of their workforce.
Naomi, I'm curious, when we broaden this conversation out to just the social media space and the concept of fact-checking on these social media platforms, is that just going to eventually continue to, are companies going to keep moving away from that? Is that sort of where the trend is here, whether it be Meta with Facebook and Instagram or things like TikTok or maybe Blue Sky, or all of those sort of just going to slowly move away from this?
I don't know that that's actually clear. What we might actually see is we might see social media companies kind of become in two different camps, right? We've seen Twitter go in one direction. It's dramatically reduced its fact-checking programs and its efforts to police potentially problematic info on its site. And we've seen the site become more conservative. But other companies haven't made those kinds of moves. We haven't seen those kind of dramatic changes from a social media company like TikTok, which is incredibly popular here in the United States. And we haven't, there are other sort of smaller sites. Blue Sky has indicated, it has a smaller staff to address, content moderation issues. It hasn't indicated that, it's going to have make such dramatic changes in the way that Mark Zuckerberg has, and it hasn't offered a similar tone or rationale for its efforts to police potentially problematic content on its site. And so I think what we could see is a continuing decentralization of the social media space. And we could see people kind of flock to their own echo chambers where they're going to, be exposed to content from people who think like they do.
Naomi, I also want to ask about financially what all of this means for Meta, right? You talked a little bit about how part of this is financially motivated because sort of appeasing Republicans maybe will be good down the road for some of the Washington investigations and such. I also wonder, is Facebook saving money by eliminating this fact-checking, folks? In addition to that, does it also sort of boost engagement if there are not curbs on certain posts?
Those are all really good questions. So the company has indicated that there are going to be some personnel changes aligned with this. They've said that they're going to be moving some of their trust and safety staff out of California to Texas. Maybe that saves them some money down the line. It's possible that, the content on the site will become potentially more toxic and drive that engagement that might affect its advertising business. But I think the other really critical question is how advertisers themselves feel about Meta. Twitter, or X rather, has lost a lot of advertisers, and it struggled to regain their trust after it made these dramatic moves to reduce its efforts to police its platform. The question is, will advertisers stick with Meta if there are similar results? Meta was always a more important tool for advertisers because of the way it allowed marketers to reach customers at the time that they were, thinking about making a purchase. And so it was always a more valuable tool to them than X or Twitter was. And so the real question is, if the site has more quote unquote bad stuff, as Mark Zuckerberg said earlier today on its site, will marketers stick around and continue to put their advertising dollars on that platform?
A key question for Meta moving forward. Naomi Nix, thanks for joining us today.
Thanks for having me.
Stick around, much more market domination still to come.
Will impose new tariffs so that the products on our stores will once again be stamped with those beautiful words, made in the USA.
That was President-elect Trump earlier today, speaking on the possibility of new tariffs. Our next guest believes the U.S. could come out ahead in a tariff war, and Donald Trump could have President Biden and his roaring economy to thank, at least partially. Joining us now, Ishwar Prasad, a Cornell University professor and author of The Future of Money, How the Digital Revolution is Transforming Currencies and Finance. Ishwar, thank you so much for being here. This is something you wrote about recently, and indeed the economic backdrop is a part of this picture. So what do we need to know about that now versus in Trump 1.0? And what that means for the U.S. firepower and negotiating power when it comes to these tariffs?
So now the reality is that we don't know if there are going to be tariffs, how large they're going to be, against whom they're going to be directed. But the reality is that compared to the first Trump administration, this is going to be a very important bargaining chip for Trump. And that's because the U.S. economy now stands out relative to the rest of the world in terms of the strength of its performance. If you look around the rest of the world, practically every other major economy, every major US trading partner is floundering. China in particular seems to have hit a very rough patch, but Europe is not doing very well at the moment. with industrial powerhouses like Germany in particularly difficult trouble, Japan not doing well, even India, which was in pretty good shape until recently in terms of its growth, has started to slow down. So in that sense, the US is in a very strong position, especially because for many of these economies like China, Japan, Germany, and many European countries, exports are very important for their economic growth. For the US, it's not that important. So the strength of the US economy, the fact that it relies less on exports to drive its growth, puts the US in a very strong bargaining position when it comes to tariffs.
Ishwar, with that, given the U.S.'s strong position already, perhaps also a little bit different than Trump 1.0, right? The U.S. economy being in a stronger position as he comes into office from a growth perspective. Do we need the tariffs to the extent that he's sort of proposing them, or is that perhaps an inflation issue? How does it balance there? It feels like the issues are a little bit different than Trump 1.0, at least from the economic perspective.
That's certainly a good question, Josh, because Trump seems to be talking about tariffs not just as a tool of trade policy, although he does talk about how many of these trading partners of the U.S. Are exporting much more to the U.S. than the U.S. Exports to them. So he certainly wants to correct the trade deficits, but he's talked about how tariffs can also be used in order to get countries to limit the flow of illicit drugs like fentanyl and even immigrants to the U.S. So he seems to view tariffs as a very broad policy tool. Just today, he argued that if Denmark, is not excited about turning over control of Greenland to the United States, he might impose tariffs on Denmark. So right now, tariffs have become a major policy tool in order to accomplish economic as well as geopolitical objectives of the United States. So it's hard to see where this is going to start and where it is going to stop. But you're absolutely right that right now, the U.S. certainly might face some costs from tariffs as well, because imposing tariffs could make inflationary pressures in the U.S. continue to be persistent, although tariffs will also drive up the value of the U.S. dollar, which could reduce some of the inflationary pressures because it would make imported goods cheaper in U.S. dollars. But certainly it will do no big favors for the U.S. economy. But it's in a relative sense that tariffs will hurt the U.S. a lot less than it's going to hurt the major trading partners of the U.S.
Ishwar, you brought up inflation, of course, and today we got yet another reading on inflation, this one through the ISM services report, the prices paid component of that ticking up, coming in ahead of estimates as well, and sort of a reignition of that. When you look at President-elect Trump using tariffs as this tool, when you look at the economic backdrop, as you say, how much is that fear of inflation going to be a curb on what he does, or is it not?
Now, there is a demonstrative aspect to his policies. I mean, he's promised that he's going to impose tariffs. So I suspect that we will see at least a modest amount of tariffs on at least a few countries so that he can fulfill his campaign promise. And then I guess the hope would be that the fact that he's showing that the tariffs are not empty bluster and that he's willing to move forward with them will cause other countries to change their policies. Maybe China will come to the table and argue that, in fact, it is going to take measures to limit the flow of illicit drugs to the U.S., that it's going to limit maybe migration flows to the U.S., maybe that it will buy more U.S. products. All of that could allow Trump to declare victory without having the negative effects of tariffs in terms of raising U.S. inflation. But I think we will see at least some tariffs. The other important thing to keep in mind is that I started off by arguing that we don't really know how broad the tariffs are going to be, whom they're going to be imposed against, but this is going to create a lot of uncertainty for businesses in terms of potential supply chain disruptions, in terms of access of U.S. exporters to foreign markets. So that's not all going to be great for job growth in the U.S. as well. So that too could curb the sort of tariffs that we actually see playing out under the Trump administration.
And Ishwar, you talked about the potential for tariffs to pressure other countries on various specific things, the flow of drugs and immigrants, Greenland, whatever is happening there. What about what Trump talked about in the clip we played? You know, the beautiful Made in the USA label coming to more goods, the reshoring of American manufacturing. Is this going to push things in that direction meaningfully?
In addition to tariffs, I think Trump is likely to shut off the ability of China to reroute exports through countries like Mexico and Vietnam. He will probably take measures to limit the opportunity that companies like Shine and Temu, Chinese companies, now have to ship goods straight to the US simply because those are low value exports. So those channels will all be shut off, and that is certainly going to incentivize manufacturers to stop locating their production supply chains in countries like China that could be vulnerable to these sanctions. It could also incentivize companies to start moving production onshore. It could incentivize Chinese and other countries to start locating production facilities in the US. All of this is going to be very gradual, though, because it's very difficult to shift supply chains or manufacturing bases overnight. But if in fact Trump tariffs do lead us into a new era of protectionism, where tariff walls are coming up around the world, not just in the US, but also retaliatory actions by US trading partners, that could certainly lead to a lot more production moving on to domestic markets in order to service those markets. So we could see a reshoring of production, not just in the US, but around the world. And this will certainly add to costs, reduce efficiency, but it could certainly help at the margin in terms of boosting US jobs. But the overall net effect is certainly not going to be a positive one.
Interesting. Ishwar, thank you so much. Really fascinating conversation. Appreciate it.
My pleasure.
Now let's get to our call of the day. UBS upgrading Bank of America from neutral to buy. The note highlighting underestimated earnings per share power, and also that this company specifically is, quote, an underrated beneficiary of deregulation. The company an overlooked beneficiary of the Basel III endgame softening. You know, we just heard yesterday that Michael Barr is going to be stepping aside as vice president of supervision of the Fed. Yet another potential domino to fall, if you will, towards the idea that banks are not going to be regulated in the same way.
Yeah, and it's interesting, Julie, you take a look at Bank of America stock. I was looking since the election at the different rallies we've seen in financials. It's about in line with JP Morgan. The way they were talking about underestimating, I was sort of curious if the stock itself had underperformed, but the stock's up about 4% over the last month or two. So it's been a part of that financials rally that we've seen sort of have fits and starts. But it seemed like kind of the key call out here essentially was that UBS sees higher net interest income over the next year than the street does. They see about 5% higher net interest income. Net interest income, according to them, is the key driver of earnings for Bank of America. Therefore, they just see the stock doing a little bit better than some other people. And that seems to be basically the sort of be-all and end-all of this call a little bit. And it remains to be seen whether if UBS is that far above the street estimates, are they just early in realizing this? Or is consensus actually have this one maybe a little bit right and UBS is a little bit ahead of itself there?
Yeah, we'll see. All right. Coming up, Wedbush adding rideshare app Uber to its best ideas list. We'll speak to the analyst behind that call on the other side.
Wedbush adding Uber to its best ideas list, highlighting the company's positioning when it comes to autonomous vehicles. Nvidia CEO Jensen Huang spoke to Yahoo Finance earlier today about the revenue he's expecting to see from self-driving cars.
Well, in order to train a robot, you need a lot of data. And the first version of consumer robots that we're all going to engage is the self-driving car. And we've been working on self-driving cars now for some time, and the business is some $5 billion estimated run rate this year.
For more, we're bringing in Scott Devitt, Managing Director of Equity Research at Wedbush Securities. And Scott, I want to start with just Jensen Huang clearly bullish on autonomous driving there. How does Uber fit into the autonomous driving story?
Well, yeah, assuming that we get there in some duration that's investable, then I think that Uber supports the autonomous industry by providing distribution. So it's a hybrid model such that autonomous vehicles get added into the human vehicle options that exist in the Uber marketplace, and they create various partnerships on a global basis that become additive to their overall portfolio. But the bigger question really is more around the timeline of autonomous, because it's comforting to think that Uber may be well positioned when we get to fully autonomous, but that's probably the greatest risk to its business model as well. And our call is that in the interim, Uber's competitive position, the cash flow that it generates, are more going to drive its price than that longer term autonomous position. And so the back and forth that you've seen at the end of 2024 and you'll likely see in 2025 is more going to be around how successful Waymo and Tesla are or aren't in terms of moving forward this autonomous initiative in a fast path plan.
So do you think Uber has taken the right approach in partnering? I mean, Waymo will be available on Uber at some point where Waymos are available. Was that a smart move, do you think? And is that going to be helpful for Uber?
I do. I think, companies can't do everything, right? So if you think about Waymo at scale, Waymo did 4 million rides in 2024. Uber did 100 billion, so 0.04% of the rides. So the number of vehicles that Waymo would need to own, because they own their vehicles, whereas Uber, somebody else owns the vehicle. You're talking hundreds of billions of dollars of investment, all regulatory approvals, mapping capabilities such that it functions in every city. We may get there, and Waymo's, at the moment, likely the best position, but we're nowhere near there. So in terms of Uber taking that burden on, I think that they've taken the best approach, which is this partnership approach for their business model, and let others make these significant investments around the game-changing technology. So when you fast forward, call it 10, 15 years, who will be the biggest winner? Well, if autonomous proves to not be something that functions economically or that Tesla figures out the technology, then Uber will win the most. If it is, then it's going to be a different company. And so you're playing this like back and forth game until you determine what is actually going to happen with the technology. And that's the part that nobody really knows quite yet, except that Waymo works in a few markets and Tesla doesn't work at all. It works as a novelty for those that own Teslas, like myself. But every time I turn on FSD in my own vehicle, if I didn't intervene, I'd be dead. So it doesn't work at scale for people to not have humans in a seat, and we don't know when that's actually going to be.
And Scott,
not to be too blunt.
Well, thinking about that from an investor perspective, if I'm an owner in Uber shares, what is timeliness for autonomous to start working? Like, is that a 2030 story that it then becomes maybe part of the story, or is it a 10-year story? How do you think about the timeline when it comes to that?
So Elon Musk has said that they will have robotaxis on the road in calendar 2025. And if you look at the performance of the two stocks, you could argue or debate what's been driving each stock, but certainly a factor has been autonomous. And so you have to ask yourself first, do you think robotaxis will be on the road in 2025? Anybody that has or has tested FSD V13, which is available on Tesla vehicles that have the latest hardware, but not the vast majority of their fleet, It's better than what existed before, but better is not good enough. To have a car on the road that doesn't have a human driving it needs to be best. 0.00000% defect rate. And so 2025 in that debate, as it relates to Tesla specifically, seems like it's a no, in my opinion. As it relates to Waymo, it's more of a question of how many cities can they do? What are their interests in growing into other cities? How quickly? And what are their long-term ambitions in terms of, do they want to do this, or do they want to ultimately license their technology to others? And then as it relates to your broader question of like when, we don't know when. You know, if it's not 2025, I think the push and pull in terms of valuations will work back in Uber's favor for a period of time. When this all comes together, you know, I think I'd have to acknowledge, and I do, that like this isn't a forever stock because we don't know the ultimate answer yet.
Right.
I'm speaking about Uber. It's good enough for now, which given a 30% pullback makes it, you know, quite appealing. But the question is not going to likely be resolved in 2025, and it may not be in 2030 either.
I want to sneak in another question on another theme that you're looking at that's also been talked about at CES, and that's agentic AI, right? This idea that we're going to get these AI assistants and agents. The stakes are a lot lower than safety and being on the road, right? But what would be your top pick linked to that idea of agentic AI? Would it be something like an Airbnb that's going to be able to use it? Is it a Meta? What do you think?
Well, I think that the endpoint consumer platforms, the Airbnbs, Bookings, and Amazons over time will find ways to weave agents into their business models. I think the two most notable in the more short term are going to be Meta and Alphabet. And so in terms of capabilities from a digital assistant standpoint and otherwise, that those are the first that are likely going to incorporate this. And keep in mind, you know, as you know, that like there's hundreds of billions of dollars being spent on deploying the capital to allow corporates to build the services for AI. And we're now entering this phase where the corporates are going to need to figure out how to build those capabilities into their businesses to justify the investment that they're made. And I think the two that really stand out, both of which we do recommend, and Alphabet is on our best idea list as well, would be Meta and Alphabet.
Scott, we have to leave it there. Appreciate you joining us today.
Thanks so much.
Well, we're wrapping up today's market domination. Don't go anywhere. We've got you covered with all the action following the closing bell.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
There's the closing bell on Wall Street, and now it is market domination overtime. Jared Blicker going to be along in a moment to get you up to speed on the action from today's trade. Let's start with the major averages here and where they ended the session. We did see a dip throughout the day, but really a last gasp of selling here also as we came to the closing bell. The Dow finishing lower by about 178 points. That's a 0.4% drop. The S&P down 1.1%, and the Nasdaq down about 1.9% when all was said and done. So, Josh, Are we back to the good news is bad news, or what is good news and bad news anyway? I don't know. The JOLTS report seeming to be a little bit more positive on the jobs front than expected. The ISM services report better, but prices paid as part of that higher than expected. So,
I mean, it definitely feels a little bit like good news is bad news, right? From an economic data perspective. We know the market's been a little bit fickle with inflation fears coming into this year and the fact that maybe the Fed won't cut. I mean, it's perhaps positive we're not having the Fed might hike conversation, but that feels like a conversation that the market wants to get to sooner rather than later at this point. But yeah, I mean, you get the 10-year up near 4.7. The move has been when yields are rising, when rates are rising, stocks have been falling, and that really hasn't changed over the last week or two.
Yeah, and of course, and we'll toss it over to Jared, there is one group in particular that takes it worse than the rest when we see yields go up, and that's tech, and we saw that today.
Yes, we did, particularly in the semiconductors. And what about Nvidia? That was quite the rug pull. So let's get to the major averages. We're looking at the Wi-Fi Interact behind me. And in the U.S. and also Canada, we'll add to that a bunch of red for the day. Nasdaq down almost 2%. The Dow is the least worse off. It was down 0.4%. But as you and Josh were just focusing on, I want to take a look at the bond market. This is a 2-year chart. And what we are now up against is last year's highs. From the early to mid part of last year. We are now threatening to go above those, and then we're looking at 5.0 on the 10-year. So we're not quite there yet. 4.75% is a big one, and then after that, 5% is a big one. But the higher these yields go, the more difficult it is on the rest of the risk market. And say that 5 times fast. Let's go to the sector action. We only have a couple in the green. That would be energy and healthcare. Arguably some defensive action there, but we've seen WTI crude oil come alive for a while. I'm not going to get to that just yet, but I will say that tech, communication services, and also consumer discretionary, what we know as the mega cap sectors, all 3 of these at the bottom right of your screen, all down 1 to 2%. Those were the biggest laggards of the day. And you can really see this if we dial up the Nasdaq 100. Here's Nvidia. Only this morning we were talking about record highs. It opened at a record high, but it was not able to continue that. And I'm going to be talking about some of the rug pulls that we've been seeing in Nvidia over the last few years with in the takeaways in about 30 minutes. But here's that 2-year chart, still up 840%, but nevertheless, there has been frustration along the way. So we'll just leave it there for now. Even Broadcom down about 3%, and we might as well just jump over to the semiconductors and see how red that space is. Taiwan Semi down 4%, again, Nvidia down 6%. And if we take a look at the software side, also seeing red there, not as much dark red as we're seeing in the semiconductors, but Shopify down 6.5%, Datadog down 3%. And I'm going to leave us with unprofitable tech. That has been a space that has seen some interest, some enthusiasm from investors this year, but not today. Tesla leading, the largest of the pack, leading the way down 4%. Just covered Shopify down 6.5%, but Block down 4.5%. Hollywood, Robinhood down 5%, and Coinbase. Talking about rug pulls, Bitcoin, a nasty rug pull after breaching 100,000 to the upside. So we'll talk about that too in about 30 minutes. Guys?
Looking forward to it, Jared. Thank you. Well, traders are pairing rate cut bets after new economic data, putting pressure on markets and pushing those yields higher. Our next guest expects the 10-year yield to remain between 4 and 5% this year. He does still remain bullish on equities for 2025. Fidelity Investments Director of Global Macro, Jurrien Timmer, is joining us now to discuss. Great to see you, Jurrien. So, you think rates will remain between 4 and 5%, but is that outlook at risk? Are risks climbing that we could see the 10-year actually push above 5?
It's certainly possible, but clearly we're in a regime, and we have been since 2022 when the whole rate spectrum reset, with the Fed obviously ratcheting rates up towards over 5% and the bond yield as well going up. That's an environment where that we haven't really seen for several decades. Back in the 80s, we had the Fed model that Alan Greenspan so famously had in his toolkit. And whenever yields rise and they're at a level where they compete with equities, which, of course, a few years ago, when yields were 1%, they didn't compete with equities because there was no alternative. That was the TINA trade. But now at 5% or 4 3/4, and the equity market having a similar earnings yield, stocks have to compete with what we consider to be the risk-free asset. And when those yields go up, the stock market needs to compete because investors expect a premium from stocks because they are generally more volatile, although certainly in 2022 that was not the case. So I think we're in this environment where, the term premium, which is essentially the risk premium on long-term bonds, has been suppressed for many years because of the Fed's and other central banks' heavy hand on, suppressing risk premia through quantitative easing and zero interest rate policy. Those days are now in the rearview mirror, at least for now. And so that allows yields to climb and the term premium to return to normal. And right now, the term premium is about 0.5%, but historically, that's been closer to 1 or 1.5%. And so if that mean reverts back to a more historical average, you could see occasionally the bond yield poking through 5%. And as we see today, and as we saw several times since 2022, when equities are expensive and bond yields are a viable asset class, the stock market has to take notice, and that's what we're seeing.
So, Jurriën, what do we need to get a break on this rise in rates then? Is it something like softer economic data?
Well, so my main fear, and I hope it's not realized, but my main fear is that the inflation genie was never quite put back in the bottle after the COVID spike in inflation, and that the economy, with animal spirits presumably returning after the election a few months ago, that if the economy reaccelerates without the inflation dragon having been completely slayed, that we could see, inflation, which is currently in the high 2s, go back into the 3s and maybe 3.5 or 4. It's not a prediction, but that's a scenario that I would think, prevent the Fed from cutting rates further.
And Jurriën, that's not a scenario at all that the market is pricing in, correct?
The market is pricing in a 4% Fed funds rate for this year. The Fed is at 4.5 or so. So the market is pricing in a couple of more rate cuts, and I think the Fed is already starting to say things about, let's wait to make sure that inflation actually is still having that downside momentum, which it really hasn't for the last few months. So I think that could put the Fed on hold, and in the meantime, as that term premium resets, it creates, a less friendly environment for the stock market, which is not to say a bearish environment, because earnings are growing. They grew 10% in 2024. They're on track to grow another 10, 12% in 2025. And so the fundamentals are still okay. But what we had in 24 was a very special 1-2 punch of earnings providing, obviously, the support for the stock market, as it tends to do, but those returns were amplified by a rising PE. So earnings grew 10, the PE grew 20, you got a 30% year-over-year return. That, to me, is going to be very hard to repeat if that bond yield is going to knock on 5%.
And so, Jurriën, I know you think earnings are probably going to do some of the heavy lifting in 2025, right? And I was looking at how earnings estimates have been cut in 2025. This was data from Data Track Research. They were looking at, so you take essentially the Mag 7, the top 10 tech names, and earnings estimates have held up for 2025, actually increasing over the last 90 days by 3.6%. Conversely, you look at the S&P 500, that number is a little bit negative. Of course, estimates always get cut, right? But interesting to me as we talk about this broadening story again going into 2025, and we're supposed to see earnings broadening, estimates are holding up for tech, and they're not really holding up everywhere else. How do we sort of square that for the broadening story?
Yes, it's a very good observation. And for the non-Mag 7, so the other 493, the earnings squiggles, right? The earnings estimate progression is doing exactly what they normally do. So sequentially from calendar year 24 to 25 to 26, and even now 27, estimates are already out for that year. The numbers are rising, so the market is expecting about 10% growth per year. Having said that, history shows very clearly that the outer estimates always start too high, and then come down because, I don't know, Wall Street analysts just plug in model numbers, I guess. I'm not sure where those numbers come from. But that is a very typical pattern. So the sequential increase is there, but the estimates start high. They start at 15% growth and they end up more like the trend line of about 7%. That's fairly normal. What we're seeing on the Mag 7, by the way, is not only rising estimates, but they're actually still accelerating higher. So for a very top-heavy market, that is, of course, important because the Mag 7 are 30% of the market. They're trading at a 38 PE, so they're expensive. So they need to produce those earnings, but so far they have.
So, Urian, zoom out for a moment because we like talking to you about other assets other assets besides just equities, besides fixed income. How are you thinking about allocation right now, and particularly allocation to something like Bitcoin, which we also like to ask you about? You know, if maybe tepid, we're going to get positive but tepid returns for stocks this year, do you want to go out the risk spectrum a little bit into something like Bitcoin?
Yeah, so my thinking on that is that, to me, Bitcoin has, now after 16 years and having not only survived 3 winters, but really thrived through them, to me, Bitcoin has earned its spot on the menu. Now, whether an investor chooses it from the menu is a decision that the investor has to make. But to me, it has earned a spot on the menu, alongside with other stores of value like gold, and these days increasingly more kind of alternatives, non-correlated assets like managed futures, et cetera. But for me, the conversation really starts with, is the old 60-40 paradigm still working? So for many decades, from the late 90s until 2020 or so, an investor just needed to have some S&P and some U.S. investment-grade bonds, and you didn't have to get overly clever about it. But now bonds are a different animal. They are now positively correlated. That term premium that we spoke about is making a comeback. And so my concern is that the 40, even though bonds are a viable asset class, they are generating a positive real yield. They are no longer that insurance policy that zigs when the stock market zags. And then we need to look at what else we put in there. And bonds have always been the most negatively correlated asset. They no longer are. Now, actually, gold is the most negatively correlated asset to the S&P, which makes it especially impressive that in 2024, gold actually went up more than the S&P did, even though it's negatively correlated. Go figure that one out. But to me, kind of the old 60-40, maybe it's more like a 60-20-20, where you take 20 out of bonds and you put it in some other little things. So you can sprinkle in a little Bitcoin, you sprinkle in some gold, some liquid alts, some other assets. Even cash is now much more competitive than it used to be. So I kind of paint that whole side of the asset allocation spectrum with a broader brush, and especially for Bitcoin, of course, a little goes a long way. We see how volatile it is. I think it has earned its store of value quality, but at the same time, we see, the Mag 7 goes down, Bitcoin goes down. So it is still a risk asset, and it acts that way in some cases. So dollar cost averaging little amounts over time, that's proven to be a very successful strategy for stocks and other assets. And I suspect it will apply for everything going forward.
Urian, we always enjoy talking to you. Thanks so much for your time. I appreciate it.
Thank you.
On this week's episode of the Yahoo Finance podcast, Decoding Retirement, host Bob Powell sits down with Fritz Gilbert, founder and author of the Retirement Manifesto, to discuss the many complexities that come with retirement. You can scan the QR code below to check out the latest episodes, and be sure to tune in to Decoding Retirement every Tuesday at noon Eastern. Here's a clip from today's episode.
So in the blog that you wrote, where you sort of recapped the 400 articles, you also mentioned some of the biggest surprises. Retirement is nothing like I thought it would be. I'm not who I used to be. Spending money is hard. Mindset matters. Focusing on others is more rewarding than focusing on self. Talk more about that in the time that we have left.
Yeah, boy, I could talk for hours about this stuff, Bob, as you know, but I think nothing like I thought it would be. I think that's an interesting one. I thought a lot about retirement, and I wrote an article 3 months before I retired called The 10 Commandments of Retirement. And it was my mindset going in, have an attitude of gratitude. Find a way to give back to others. It was kind of more mental what's my approach going to be? You know, I want to make these the best years of my life. So what's my mindset going to be going into it? And those have all been spot on. That's I wrote an article, retirement is nothing like I thought it would be. The byline was retirement is exactly like I thought it would be. And the part that was exactly like I thought it would be was the mindset stuff. You know, I'm going to pursue my curiosity and explore stuff. I've done that. But the places it's led, this building that I'm in now, this is my writing studio, and I've got a woodworking shop on the other side of the wall. I never would have had that on a list of things I would have done in retirement, right? To have a woodworking shop. I wasn't into woodworking, but that came as a result of the charity. So the places that mindset has led me is where those biggest surprises were, but it's also where most of the excitement's been, right? So that's one of them. I think the other one that's good to talk about is spending money is hard. This is a real problem. There's just a study that came out from Alliance, and they found that 48% of Americans are concerned that they're not spending as much as they could, and they're being too frugal because they're afraid of running out of money. It's a real problem, and people don't think about it, but it's hard to think about that nest egg that you've got is going to last. That's what you've got for the rest of your life. So it's a very common tendency to continue to be conservative, underspend. You can determine how much you can safely spend. And in my case, we've set up this bucket system where that amount flows every month into our checking account. And if there's money in our checking account that starts to grow, you know, my wife and I have said, look, if there's money in there by the end of the year, we're giving it away. We're forcing ourselves to spend because it's hard to make that shift, especially if you've been frugal through your career. So don't be surprised if you find it hard to shift from a life of, you know, being pretty conservative and frugal to knowing you can spend this money, but still struggling to spend it. That was a surprise for me, but it's a common surprise. So I think that one's relevant. And then the last one I'll say, you know, if you're really struggling with trying to find your purpose and you're in this stage 2 kind of confusion, you're not really sure what you're going to do, I really encourage people, your whole working career, by definition, you've kind of had to be focused on self, right? You're trying to get this promotion, you're trying to do good at work. Well, if you're in retirement, you've made it, you're successful, you've achieved it. It's a really good time in life to start looking at people that maybe haven't made it yet, you know, people that are struggling, and finding a way to use your time to benefit those in need. That's a really rich area to look at, and that's what our charity focuses on. I would argue some of my writing focuses on that. It's people that haven't yet retired. It's a way to help people that are still trying to figure it out. That's others focused, right? So the more things you can find that are focused on others, that's generally a really a good path to look if you're trying to figure out what you want to do in retirement.
Anthropic, the AI startup founded by ex-OpenAI executives, is in late-stage talks for raising as much as $2 billion at a $60 billion valuation. That's according to a report from the Wall Street Journal. The latest funding round being led by venture firm Lightspeed Venture Partners, and Anthropic is also backed by Amazon, which committed $4 billion to the startup in November. Anthropic is competing against the likes of tech giants like Meta and Alphabet, who are also investing billions to build their own AI capabilities. According to data provider CB Insights, the deal would make Anthropic the fifth most valuable U.S. startup after SpaceX, OpenAI, Stripe, and Databricks.
Natural catastrophe insured losses mounted to at least roughly $135 billion globally in 2024, according to Swiss Remarking, the fifth year of losses above $100 billion. While looking ahead to 2025, natural disasters are not the only risks top of mind for insurers. AXIC CEO Vince Tizio joins us now with a closer look at the risk landscape. Vince, I want to just start broadly. What are the key risks that you're hearing from clients right now that they're most concerned about going into 2025?
Sure, Josh. Good to be with you and Julie. So I think there's three major risks that we're evaluating and certainly trying to provide as much assurance to our customers globally as possible. The first relates to natural catastrophes' effect on companies' balance sheets, their ability to remain in business. And that can take the form of wildfires, hurricanes, tropical storms, hail, and all the like. So natural catastrophes is one area. The second is an important area called directors and officers liability insurance. You know, think about the people that are really charged with running organizations, both public and private. In this regard, there's a strong amount of data to support the increasing need around this important coverage, including bankruptcy rates, which are up around 8% over the prior year, almost reaching the post-pandemic financial crisis levels. Additionally, severity of so-called security lawsuits at all-time highs. And then finally, this increasing challenge around liability insurance, the liability crisis as it's been regarded and called social inflation, essentially saying that loss costs associated with handling claims for corporate customers is rising at an exponential rate. And the ability for insurers to continue providing coverage is really important.
So let's dig into this a little bit, Vince. It's Julie here. Thanks for being with us. I'm really interested in this sort of climate or weather-related events. Have indeed those been going higher, right? We've seen some in the insurance industry, more on the residential side, abandon certain markets because it was too difficult to insure them. On your end, what are you seeing? Is that an opportunity for you all, or is it sort of a different niche in the market?
Julie, it's really a corporate responsibility. We're a specialist insurance company. One of our core capabilities is delivering property insurance globally. Be reminded, please, that we cover insureds all around the world. And there's different types of losses that are occurring and arising. And within the last 5 years, the loss landscape of catastrophes has been fairly substantial. Increasingly, the complexion of how property damages are occurring is really aligned to the changing weather patterns, whether it be the convective storms that you see routinely in the Midwest, hail, whether it be wildfires that we've seen persistent for many years now, and certainly the most well-known is the hurricanes and the effect of them. And so incredibly important for commercial entities around the world is the safety and security of their goods and services, their plants, their manufacturing capabilities, and of course the welfare of their people. And we stand ready to continue providing that important coverage.
How do you price that coverage if we are seeing an uptick in frequency and severity? And not only how do you price it appropriately so that you are encapsulating the risk, but price it appropriately so that people, so that entities, corporate entities, can still afford it?
Yeah, so it's there's some special sauce, of course, associated with the pricing, but fundamentally, this is a business. Property insurance is a business that's rated off of examining the properties that we're insuring, the quality of the roofs, the quality of the egress and the exits, the data that supports their historical losses, their geographic proximity, where they're located, how they are constructed. These are a number of the elements that we account for in the calculation of price. But you point to something really important. which is for commercial insurance to have the certainty, the reliability of consistency from the insurance company in their capital deployment and, of course, their pricing. Now, in the last 5 years, property insurance has been quite expensive for commercial insureds, really resulting from the risk landscape, which is forcing insurance companies to charge a commensurate price.
Vince, I want to shift gears a little bit. I was reading that you guys are also offering insurance to help with AI liability. I'm curious sort of how does that work? What kind of company would need to get insured for AI liability? And given the growth of that industry, is that a potential giant growth area for your business?
You know, AI will affect a number of insurance products that commercial consumers purchase, right? It starts with the governance within companies around the use of AI, the privacy protections, and so directors and officers again. Additionally, there's the ability to bring AI into the operating capability of the firm. Many commercial insureds will try to utilize AI in the provision of reducing its exposures to loss. And so we have a number of products, whether it be our cyber product that's responsive, our directors and officers liability product, our property product. A number of our insurance products are responsive to covering the kind of events or claims that might arise in connection with companies utilizing AI.
Vince, thank you so much for your time. Appreciate it.
Thank you.
It's time now for What to Watch Wednesday, January 8th. Starting off on the earnings front, we'll be getting an earnings report from Albertsons, the supermarket chain. The company announcing results for its third quarter before the opening bell. And analysts expect the grocery giant to refocus on growth after its failed merger attempt. Of course, that attempt was with Kroger. They announced the termination of that agreement last month.
Moving over to the job market, fresh labor data coming out in the morning with ADP employment. Economists forecasting the private sector added 139,000 jobs in December, roughly in line with the increase seen in November.
And taking a look at the Fed, we'll be getting some more Fed commentary from Governor Christopher Waller. This will come after comments yesterday from Fed Governor Lisa Cook, who said that Fed officials can be more cautious with rate cuts going forward. Also tomorrow, minutes from December's FOMC meeting, where the Fed cut interest rates by 25 basis points.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of this break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. welcome to Asking for a Trend. I'm Julie Hyman in for Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. A down day for markets with Nvidia and Tesla leading losses in tech and dragging down the Nasdaq as a whole. We'll explore the rest of today's market trends. Then companies around the country are bracing for the possibility of new tariffs once Donald Trump returns to the White House. We'll tell you why at least one small business is welcoming them. Plus, we'll sit down with Mercedes-Benz US CEO to discuss the carmaker's fourth quarter sales and where it's headed in 2025. Well, the Nasdaq leads stock declines as traders pair rate cut bets while Nvidia retreats from its record close. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Hey, Jared.
Thank you, Julie. We got to talk about Nvidia here because there was so much excitement yesterday before Jensen Huang's big CES speech. We hit a record high. Nvidia hit a record closing high. And then after the speech overnight and in the early morning, hitting more record highs. But guess what? This ended up being the worst day in 4 months for Nvidia. And I wanted to show you a 2-year chart here because we've seen this movie before. Basically, the bull market is about 2 years old, going back to October of 2023. And we've seen this 4 times before. So the most recent was on November 20th. And I'm writing about this in the morning brief. And we had a bit of a pullback here, about 13%. But you can see this was an even bigger one. That was a 27% pullback from June 20th, hit $140 on a split adjusted basis for the first time. But then we also saw this one in here, and I'm not going to go over all of these, but you get the picture. This was this was over a 6-month consolidation that we hit. Earnings finally got $50 on a split adjusted basis for the first time, and then it was just sideways. So we've been in this bull market for 2 years, but we haven't needed Nvidia 100% of the time, is my takeaway.
Interesting. Okay, so we had that movement there.
Yes.
You're also watching Bitcoin, I know, on the day too, because there too
Yes.
fits and starts is kind of like Bitcoin's middle name, right? Like
Bitcoin fits and starts.
Yeah.
Yeah, don't say that too fast, but yes. So Bitcoin gave us a head fake today too, and we've seen this movie before, specifically with the $100,000 price level. Let me go to our heat map here. I'll get the coins up and everything else with Bitcoin, and I'll show you the chart. So we've been kind of fixated on this $100,000 price level. Let me just give you a 1-year chart, and you can see we've been here for several months, and post-election, that's right after the election is when we get that pop. But look at this. Bitcoin did nothing for most of 2024. So we've seen this before as well. Things consolidate, then they move up, then they consolidate again. So I'm just seeing 97,000. It's a big negative day for Bitcoin, grabbing a lot of headlines, but I don't think it's a long-term potential headwind. I think it's just more crypto volatility.
Don't they sometimes consolidate and then move down, though?
They do that.
Okay.
And we can see that in this 5-year chart because we can see, all right, we hit a new nominal high here in 2021. Here's a big run up in 2021, but then we hit a new nominal high and we had, what was that? One of those 50%, might have been 70% corrections. It was definitely a Bitcoin winter. So yes, sometimes that happens as well, and there's no reason it couldn't happen here. It's just momentum, and all the time frames are still favoring the bulls until we see otherwise.
Okay, then yeah, go ahead.
I was going to say 90,000, watch 90,000. That's a key level to watch in Bitcoin.
Gotcha. And then remind me of the last thing we're talking about.
All right, I'm on pins and needles too. Oh,
energy. That's right.
We got to talk about energy. And we didn't even get to the 10-year T-note, which is kind of pressuring things higher today. But let's just go to energy. And I'm going to go to our heat map where we can check out what XLE has been doing recently. It's just kind of perked up. We haven't seen a lot of risk on sentiment necessarily consistently from the other sectors, but energy here has been doing well in the new year. Here's a year to date, just a few pinpoints here, but up 2.66%.
It was the worst performer last year, was it not?
Yes, and people looking ahead for the Trump trade, it's worth remembering what happened back in 2017 because I think it was like right around here. We saw an initial dip, and then we saw a rally, and then we saw a big dip going into the pandemic. But the bottom line is energy was supposed to be a Trump trade, and then it was a disappointment. I would look at the price action. And so here's what I'm looking. This is the max chart on XLE. This goes back to 2000, and you can see we are pressing right up against these record highs. So I think that's why we're stalling out here. We get above these record highs, above 95, say, maybe even 100. It's off to the races, but that's a long-term chart, so we got a lot of work to do there.
We'll see what happens this year.
Yes.
All right. Thanks a lot, Jared. Well, in 2022, Guardian Bikes opened a new factory in Indiana, shifting its production to the U.S. from China. However, nearly all of the parts for the bikes still come from China. While other small business might be sweating the possibility of new Trump tariffs, Guardian Bikes is welcoming them. Joining us now, Brian Riley, Guardian Bikes CEO. Thank you so much for being here, first of all, Brian. So talk to me about why you think tariffs might end up being a good thing in terms of how your supply chain works.
Yeah, Julie, thanks for having me. A couple of years ago, we decided to set off on this journey of essentially doing a multi-phase approach to reshoring a supply chain. So first phase was build an assembly plant in Indiana, and that's basically what we've done. And now we're assembling hundreds of thousands of bikes a year at this plant in Indiana. The next phase is starting to make our own frames in Indiana using U.S. steel, and also partnering with several U.S.-based suppliers on getting them into the business of making parts for bikes, and also talking to foreign suppliers who might be interested in moving to the United States to make parts in the United States. So we're well into our journey into this kind of phase 2 of our approach. We're starting to make frames this year, and we're deep in conversations with several U.S. suppliers on making parts for us. So this whole transition of what we've been trying to do from the beginning of shifting as many parts as we can to the United States, any tariff increases actually help accelerate that dramatically. We're already planning to do it with the tariffs where they are today, but certainly to the extent that there's additional tariffs, it's a little bit of short-term pain, but it really allows us to accelerate more and more onshoring, which has been our goal from day one.
Well, I guess the question is how much accelerating, right? Because you can tariff it and then provide that financial incentive to have manufacturing in the U.S., but you still have to have the facility, you still have to have the raw material, you still have to have the labor, which I know was something that initially was a challenge for you guys. I mean, all of that is going to take time, no?
Yeah, I mean, this all takes time, and it's a multi-year approach. Again, we really started planning this during COVID. We anticipated that the U.S. relationship with China was really never going to be the same again. And so, it took a couple of years to plan this facility. We started the facility, we've scaled it up over the last couple of years. And, now we're starting to get into this, reshoring of multiple components and parts that make up the bike. So yeah, it's a long journey. But at the end of the day, I think the tariffs are intended to create this kind of activity and create this kind of reshoring. And I can tell you from, living in Seymour, Indiana, it's a small town. This type of activity, creates jobs. We've created 250 jobs so far at our plant, and only are creating more the more that we get further into this path of vertical integration and making more of the parts in the United States.
Now, I know that you guys are working towards, when we talk about parts, things including the frame of the bike that you guys are working on sourcing in the United States. Where is that going to come from, right? Who do you contract with to make that, given that we've had sort of this dwindling steel industry in the U.S.?
Yeah, so the frames we're going to make ourselves in our Seymour plant.
But I guess what I'm asking is, you're making the frames, but where do you get the stuff to make the frames?
Yeah, so one of the reasons we've set up in Indiana is because Indiana has a lot of great steel mills. So we're actually partnering with a tube steel mill that's just up the road from us in Columbus, Indiana, about 20 minutes away from where our facility is. And we're buying tube steel in large quantities from them, and we're turning that tube steel into frames. And so it's U.S. steel. It's from a local supplier right in our area, and we're excited about it. I mean, the economics of it makes sense. One of the reasons it makes sense is because something like a frame is a really big part. So you take away a lot of the inbound freight, and of course duties and other costs, and you can replace those with a little bit of U.S. labor. And then we're using a lot of automation in our approach, and that's one of the reasons why we can do it competitively.
That said, do you expect to have to raise prices of the bikes as you do incorporate more local parts?
No, we're not planning to raise prices at all. I mean, we found, number one, we make a little bit of a more premium product, and our customer base, gladly pays more for something that's assembled in the U.S. and eventually, hopefully, will be fully made in the U.S. And the other thing is, we do it smart. We're taking a phased approach. We use a lot of automation. We study these things in depth before we do them. And so all the things that we've done it's typically this theme of there's a little bit of short-term pain and it costs a little bit more up front, but once we master it and stabilize it, it doesn't cost as much. So we haven't raised our prices at all through this whole journey of reshoring even the assembly, and we don't plan to in taking more and more parts to the United States either.
Brian, thanks so much. Appreciate it.
Thank you.
Coming up, Mercedes-Benz reporting strong fourth quarter sales. How do hybrids and EVs fit into those numbers? We'll ask the Mercedes-Benz US CEO after the break. We're asking for a trend on the other side. Mercedes-Benz USA releasing fourth quarter sales numbers and reporting 9% growth from the year before. For more, we're bringing in Dimitri Psilakis, CEO and President of Mercedes-Benz USA, as well as Yahoo Finance Senior Autos reporter Pras Subramanian. Dimitri, thank you so much for being here. So let's just start with why the numbers were up 9%. But not only that, there were particular subsets, including the high end, that were up more than 50%. What was driving that?
Yeah, I would say, first of all, 2024 was not an easy year for the industry, not an easy year for the brands. And we had a really very strong recuperation in the second half of the year, ending up in having, in December, the best ever retail month for the brands, but also, as you mentioned, adding up to a very good year of 9% increase year over year in our business in the US. What was part of this success? I would say 2-3 things added to that. First, we have a very strong brand, which is highly appreciated in the US. We have a very strong dealer network, and we had a very strong portfolio of products, especially in the second half year. So new launches during 2024 and full availability of these products in the second half year, and especially in the last quarter of the year, helped us make this jump of 9% on year-over-year on sales.
Hey, Dimitri, Pras here. So you mentioned some of the new product coming to the portfolio, the E-Class in particular. I saw a strong sales there. But also we're seeing this mix where hybrids, plug-in hybrids, and also mild hybrids doing quite well in the 100%, 4 times sales compared to last year, whereas EVs sort of dropping off here. What are your customers telling you about that? Are they preferring hybrids here?
I think the reality we face in the US market is that the adoption rate of electric vehicles was not as steep as everybody was expecting. We reacted to that by bringing in the US markets a range of plug-in hybrids. The last one to be launched was the GLC plug-in hybrid in September this year, and that has been our best seller, I would say, in the last quarter of the year. Plug-in hybrids bring the best of 2 worlds. Internal combustion engine on one hand, and on the other hand, an electric range, which in the case of the GLC, for example, it's 54 miles according to EPA. So the best of 2 worlds, and any concern, any range anxiety, any time to charge is going away. So plug-ins are a success at the moment.
So where does that leave the pure EV strategy, Dimitri? Is that something that you all are going to be pulling back on in the years ahead as well, or you're going to kind of feel it out depending on what the market dictates?
Not at all. We're steadfast in developing the best electric vehicles for the demands in the markets, and we'll be following the trend and the speed of adoption. So we'll be offering both technologies in the future. Internal combustion engines will continue developing them well into the 2030s, but would stay also very committed to an electric vehicle strategies for all our products. So at the end, it's the choice of the customer whether he wants to go electric on an early stage or he wants to go electric on a later stage. All technologies are on the table, and they will be there for a long time.
Hey, Dimitri, so last time we spoke in person was, I believe, in Pebble Beach in Monterey during the car week, and coming off a strong December, we saw a lot of your luxury clients out there, and I think they're sort of buying more cars these days. What are they telling you right now about where they are situated, given where we are with the markets and the new administration coming in the U.S.?
I think, Prasan, you're right. We had good discussions in Pebble Beach in an environment where you can showcase the best of what the industry can bring. And that's how we use Pebble Beach. So their customers basically go for individualization, go there for products which reflect themselves, whether this is performance, whether this is luxury, whether this is measured to their needs in terms of colors, execution of the product. And I think this is what we as a brand were consistent in offering in the US market, both in terms of the product, but also the services that our dealers are offering to the customers. You saw there the SL Maybach 680, right, which will come in the market next year. That's a very exclusive product. So this is part of the strategy, working on the top end of the premium segment.
The incoming administration, as you know, has really emphasized making things in the U.S. You all do have manufacturing operations here. Are you planning on expanding that because of some of the incoming possibility of tariffs, for example?
As you well know, we have a long history in the US market. We're here for over 60 years, and we're also very strongly placed when it comes to manufacturing. We're producing in the US and exporting out of US to the rest of the world our SUVs, both internal combustion and electric and plug-in hybrids. We have a factory producing sprinters. So we do have a strong base, and obviously our intention is to strengthen our presence in the US market. But at the same time, as a global manufacturer and a medium size, I would say, we cannot produce each and every product in the US market. So we are producing in Europe and exporting to the US, but at the same time, again, producing in the US and exporting to Europe or the rest of the world. So we believe in the markets. We're here. We'll continue being here, serving the US customers along with our dealers, and we want to have a prosperous business.
Dimitri, a lot of these automakers are international, as you mentioned, Mercedes, operating in many different regions. We're seeing, just taking a step back, we're seeing companies like Honda and Nissan exploring mergers. Do you think that we'll see more of that in the space, that bigger and bigger mergers as companies try to compete on a cost level, even the most luxury high-end brands?
I think this is a challenge we all face, right? There is a crunch at the moment. We have macroeconomic conditions which are pretty challenging. We have conflicts around the world which make the business more challenging. And we have this also, let's say, also challenge between which technology will prevail in future and to which speed. So we take that seriously, and yes, we look into areas of how can we become more efficient in doing business, how can we be more customer-oriented in our business, how can we serve in the best and the most efficient way our customers. But looking into segments of the business and looking where there are opportunities is always our effort.
Dimitri, thank you so much for your time. Pras, thank you.
Thank you.
Coming up, are Americans growing wary of jumping jobs? We'll break down in our chart of the day when Asking for a Trend continues. For our chart of the day, we're looking to JOLTS, the Job Opening and Labor Turnover Survey. Yahoo Finance's Josh Schaefer joining me now with a closer look and hopefully not acronyms like JOLTS, maybe.
No acronyms, Julie. You took care of the acronyms for us. But yes, you mentioned that job openings release from this morning. Job openings ticking higher in November, but there was still some signs of cooling in the labor market, and that's what I want to highlight here. Because in the last press conference of 2024, Federal Reserve Chair Jerome Powell did mention that the labor market is in some ways cooler than it was pre-pandemic. These are two of those metrics he may have been referencing when speaking about that. So this is the hiring rate in white. This moved down again in November. And then we also have the quits rate in blue also moving down. So quits are seen as a sign of confidence among American workers. If quits are moving lower, down to 1.9% now, that means that Americans are feeling a little bit more wary about leaving their job. Well, why are they feeling more wary? Hiring has been coming down as well. So as hiring comes down, Americans don't want to leave their job as much. And it puts us in what economists have called sort of this no hire, no fire labor market, where the labor market is in this stasis right now, where not a lot of companies are necessarily laying people off, but there aren't a lot of companies hiring either. Then you get to the point where workers don't want to leave their job and things sort of stay stagnant. The key question right now for the Federal Reserve, of course, being, will these metrics stay stagnant, or will they continue to move lower? When you look at prior periods where the U.S. entered recession, of course, the quits rate came much lower than 1.9%. The hiring rate also came much lower than where it is right now. So that's going to be the key question moving forward into 2025. Can the labor market sort of stay in this perfect soft landing-esque zone?
It is indeed a big question. Josh, thank you. That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night.